Welcome back to Real Vision. Today, it's my great pleasure to host a conversation with Larry McDonald, the author of this book, How to Listen When Markets Speak, and founder, of course, of the Bear Traps Report. Larry, welcome back to Real Vision. Always a pleasure to have you with us.
Thanks, Ash. Great to be here.
Larry, you can see from all my side notes here that I've been reading assiduously. Larry, I have to say right here at the outset, this is a really impressive book, an impressive work of scholarship, and yet you managed to make it accessible to a non-technical audience, which is just an incredible feat. It's a comprehensive view of the world. I've been really getting into this book. First of all, let's just sort of frame it for folks who have not had an opportunity to buy it yet. What's the book about? What inspired you to write it?
Well, Ash, after my first book, so my first book was about Lehman Brothers. I was a trader there. And,
This is, by the way, for folks who may not know, This is the New York Times bestselling, A Colossal Failure of Common Sense, broadly thought to be the definitive book about the Lehman Brothers collapse from someone who is inside.
Thank you, Ash. Exactly. And so what I quickly learned over the last 16 years is you actually make a lot more money on the speaking tour than you do writing the book. But it's not about money. It's about the people that you meet. In other words, doing speeches in London and meeting with hedge funds, pension funds, all kinds of mutual fund portfolio managers. And so what we did was we kind of put together a private club, an investment community behind me on the Bloomberg terminal, where we kind of have a conversation every day, every week about what's really happening in the markets. And so what I wanted to do with When Markets Speak was bring a lot of that talent together and democratize information. So, younger investors can kind of pick up the book and then get a good lens on a buy-side conversation. And then also, like you said, a historical framework that kind of looks back, but we're using history to kind of look forward too.
Yeah. Larry, you start this book with the Reagan administration, the period perhaps when our current financial epoch began. Talk a little bit about the context here. Why start back in 1980?
Well, I gave a speech in the National Bank of Abu Dhabi, and I met James Baker, Neil Ferguson, and that was like a big moment for me because I was on a stage with Sarkozy. I was definitely over my skis, and it was a wonderful conference. But meeting with Baker and Ferguson, they kind of opened my eyes to what a multipolar. And the first time I heard, I didn't know what is a multipolar world versus a unipolar world, and they described the period of 1960 in the 60s to the 80s was more multipolar. And from the 80s to say 2020 was more unipolar, and so we wanted to start it off there. When you think about the collapse of the Soviet Union, and that was a big moment. You think of the end of the Vietnam War, and so when those events happened, we started to shift into what's called a unipolar world, which is much more disinflationary. Your supply chains are, faster and faster and faster, and you're less global conflicts and more toward globalization, which is very disinflationary and deflationary. Whereas once you enter a multipolar world, that sets up for much more sustainable inflation forces, which we can get into, and that's why we started it off, in the 80s.
Yeah, talk a little bit about that broader context. You talk about the context of disinflation, which most of us have come of age in. I think if you could pull up that chart of the 10-year Treasury yield, perhaps this might be the single most important macro chart. I don't know if you can see it there on the screen, Larry, but this starts out about. Well, my eyes aren't that good, so I can't see it, but I know what the chart looks like. I'm guessing it's 81 is where that peak is on the left, and you see this just steady down. Word slide of 10-year Treasury yield. And this is, for folks who may be watching this, their entire career as an investor or their entire career on Wall Street spent during this period of time. Talk a little bit about what we're seeing there and how it relates to the broader trend of disinflation and the broader macro context.
Well, once you go toward a multipolar world with a large fiscal response. So what I talked in my first book, which was about, as I said, it was about Lehman, about the crisis. And you can see on the chart there the big move down in yields post Lehman, post 2008, and then COVID. So you had back to back, Lehman and COVID were two big events impacting the bond market. And, each day and each month and each minute that disinflationary forces take hold, it really has a very incredible enabling and deceptive power over politicians, right? And so think about when Lehman went down, we talk about this in the book, where it was a 4 trillion fiscal and monetary response to the crisis, 4 trillion. But then, Ash, in the following years, we quickly went into a period of the Tea Party, austerity in the US, austerity in the UK, Brexit, austerity in Greece. And so the whole planet went into what's called an austerity regime, where the fiscal restraint was really over the top. And so to fast forward to the COVID crisis and then the banking crisis of 2023 and 24, I guess you could say we had the New York Community Bank this year, but most of the banking crisis was last year. The fiscal and monetary response, 16 trillion. So you're talking about 4 times more, 4 trillion versus 16. And that's what gets you into a much more sustainable inflation regime and a much more, much higher impact on bond yields, as that chart shows.
Yeah, Larry, I know you got a chart deck you want to walk through. Let's tee that up here because you're able to unpack the thesis visually, which I think is a very powerful way of looking and thinking about this topic.
Well, the first thing is you think about the team Biden. Now, every administration, when they're in power, heading toward a big election, and this is a big one, right? They'll do whatever they can, and whether it be Republican or Democrat. In 2008, Republicans were gaslighting information around the crisis, right? They were basically in the first, second quarter, they were kind of pretending that I'm a Republican. So, they were gaslighting the news cycle, right? Basically downplaying any kind of inflation news all of 2008. And then when you had that election, it was definitely impacted. Obama was an incredible candidate, but lo and behold, it just wasn't a very good environment for Team McCain or the Republican Party to try to win an election in a financial crisis. And so now here we are, all these years later, you get this huge fiscal and monetary response. Team Biden wants to win the election. They're trying to prevent a recession through excessive fiscal spending. Like I said, 16 trillion of fiscal and monetary. And so the net tail effect of that is in a multipolar world, which we have, much more global conflicts today than we did, say, 5 or 6 years ago. And so the net result of that is higher gas prices, more inflationary pressures. And lo and behold, CPI, since this chart was made, has bounced a lot. And so, always remember, like gasoline is a pretty good leading indicator for CPI. And so even though...
Yeah, but if we could pull that chart up on the screen that Larry's talking to, I don't know if folks can see it right now. There it is.
Yeah, that's if you could see there, that CPI has bounced a lot since then. Today, PCE came in hot. So gasoline in a multipolar world is a really good leading indicator for inflation, especially after that fiscal and monetary juice.
Yeah. And of course, today, as we're having this conversation here on Thursday, April 25th, we just got a weak print on GDP. So you have the two variables that the Fed is trying to solve for moving in opposite directions: inflation above target, growth below target. Not an ideal environment to be a central banker.
Yes, and it's very stagflationary. And once again, those, that multipolar world, that kind of like 1965 to 1980 environment was very stagflationary. And there's a whole different set, like your portfolio for that kind of world is so different than the 2010 to 2020 portfolio, which we'll get into. One of the things I talk about in the book is, we've taken 5 million jobs, Ash, 5 million jobs out of the United States. We've moved them around the world. If you work in a call center in India, you're making 10 to 50 times more than your great grandparents. And so we've raised the standard of living dramatically around the world. And so we're creating all these new carbon consumers, and we're creating all this new kind of like all these new inflationary pressures. And so, as you can see there, oil demand, as you decimate the Rust Belt, there are fathers and, walking around the Midwest right now in the Rust Belt in bad shape. I mean, life expectancy in the Rust Belt is declining at one of the fastest paces in the last 100 years. And so we've decimated the manufacturing base of the United States. We've globalized. We've raised the standard of living globally in China and India and all throughout emerging markets. But there's a price to pay for that. It's not free.
Right. Let's talk a little bit about this. First of all, I know that these are very intensely politicized issues. One of the things I love about Real Vision and this conversation with you, Larry, is we're looking at facts here, not feelings. Talk us through this chart, this oil demand chart that we're looking at. What's the significance and how does it play into the thesis you just discussed?
Well, there's 1 billion people in India that don't have air conditioning. The first thing, if you raise the standard of living dramatically in emerging market country with an average daily temperature close to 90 degrees in many of the cities, if you raise that standard of living dramatically through globalization, there's a price to pay for that. It's not free. This is a society that is consuming mopeds and air conditioning. New demand is exploding. We are creating a new generation of young, up-and-coming carbon consumers throughout most of the emerging markets. And this, is going to be very hard to control because you can't force emerging market countries into, wind and solar very fast. And all you have to do is look at the Paris Climate Accord of 2015. A lot of those promises from 2015 from China and India have been thrown in the trash. China's coal consumption has exploded off the charts since the Paris Climate Accord. And so those are the real world, indicators around future energy demand. One of the things we talk about next in the book is a multipolar world, which, with drone attacks on refineries in, say, Russia and the potential for that in the Middle East. We never had to worry about that before. And so
we've got that slide right coming up next, I believe.
Yeah, so this sets up for like a lot of technology around drone activity sets up for a very interesting backdrop because when the oil market's tight and you have all that demand coming from emerging markets in terms of energy demand, and then all of a sudden the market tightens because of refineries being hit by drones. I mean that quickly gets you into a very stagflationary environment. And once again, this isn't, like Neil Ferguson says, the famous economic historian, this isn't a book about gloom and doom. This is a book about resetting your portfolio for a whole new world.
Yeah, we should say he's, of course, written the preface for this book.
Yeah, very grateful to him. And so one of the things that, I sat down with Charlie Munger in the book. We sat down with David Tepper, David Einhorn. One of the things that Charlie taught me, I met with him in Omaha, and he said one of the things that he and Buffett look at are staples versus discretionary. And so, Omaha is the famous Berkshire headquarters. I went to the annual meeting there. They invited me, and I had a one-on-one meeting with Munger. And Charlie just passed away, God bless him. But one of the things he talks about is like when you see the staples outperforming the discretionary names. So since December 21st, the staples are outperforming discretionary names by almost close to 12%. And so when this is how to listen when markets speak, right? That's the book, How to Listen When Markets Speak. So in an election year, you have a lot of political narratives, like in the media cycle. There's a lot of people that don't like Trump, there's a lot of people that hate Trump. And you just have to look at the markets. So in a strong economy, how come consumer staples, which are really recession-proof stocks like your Cloroxes, your Procter and Gamble's, your Costco's, why are these stocks outperforming discretionary names by 12% since January? It makes no sense, right? Unless something is going on under the surface. How to listen when markets speak. And remember, Ash, the XLY, right, is 24% Amazon, and Amazon is up close to 15% year to date. So I'll ask you as a market participant, if Amazon is 25% of the XLY and Amazon is up 15% year to date, how come consumer discretionary names are underperforming the the staples by that much. And that tells you under the surface, what's really happening on the discretionary spending side.
Yeah, and it does sure look like a decline in everything else. Larry, I'm glad you mentioned the Charlie Munger part of this book. It's one of my favorite sections. Charlie Munger was a great fan of A Colossal Failure of Common Sense, which I thought was an interesting way to kick that meeting off. Um, but it is, obviously Charlie Munger, who just left us, age 99, by the way, spent 70, 80 some odd years studying markets. But it's fascinating. Something that you said that I think is really important here, because obviously these issues, particularly in the context of an election season, can be highly politicized. But your take on this, I think, as you said so eloquently, is about resetting your view of markets, about what all of these changes, what are all of the things when you see students maybe screaming on your television, what it means for markets, how you need to position yourself, how you need to think about those portfolio allocation decisions. And this really, in many ways, is kind of, I guess you could think of it as, on the one hand, the Charlie Munger value trade, and on the other hand, the Cathie Wood growth trade. It's interesting to see and to think about it in that context. Talk a little bit about what we're seeing right now with this chart. And it's not on
Well,
screen yet.
this is, to me, one of the most interesting charts in the world right now. So the EWU, if you can see on the left-hand side, you're talking about, and you could go back further. I can go back further. You go back a decade, right? And you can't find one 6-month period where global value equities outperform the S&P. You can't find one 6-month, 9-month period where global value stocks outperform the S&P, right? Then all of a sudden, in the post-COVID world, once we get into this 16 trillion fiscal and monetary response, once we get into this multipolar world, we're in a new world. Everything's changed. Now, what blows me away is that the global value names are actually outperforming the S&P since 2021. And they see that flat line, not by much, but that says something when you go a decade with not any outperformance, right? So clearly money is moving from, now remember, once you move in, one of the core theses of the book is the DCF model, discounted cash flows, and how investors look at stocks. Once you move into a sustained higher yield regime with higher inflation, you want to be in names, and capital will start to flow into names of more value or companies that own assets. Whereas
Can you
growth,
unpack a little
yeah,
bit about how we got there? Because this is such an important
sure.
point in the book. Talk about the low inflation, low yield period where we saw the bid get caught on the tech growth names, because I think it's very important for people to understand when they understand the context of your regime shift more toward value.
Okay, so let's keep it simple. Let's say you have a company that produces a software company that produces cash flows, and they reinvest those cash flows over 10 years, right? And say it produces $1 billion. That $1 billion over 10 years, because it's paying out over a long period of time, that $1 billion is worth less in an inflationary regime over that 10-year period. Whereas let's say you have a value company that produces cash now and has assets. So think of Alcoa, or think of any kind of copper company, Freeport McMoran, any kind of oil and gas company, Exxon. Those companies not only produce current cash, but they have assets in the ground that are really valuable in an inflationary regime. So capital moves from your growth stocks in a sustained inflationary regime over toward your value names. And so this is kind of like, this next slide is a really telling signal. And we were looking at, okay, the Dow Jones Industrial Average versus the NASDAQ. And you can see there in 21 to 22, all those blue dots. You see how the blue dots go in patterns, and then you go through long periods without any blue dots, right? And so when you move in 2022, we moved into an inflationary regime that was very certain. And all of a sudden, there are multiple days when the Dow Jones Industrial Average is outperforming the NASDAQ. That's capital moving into more value names. And then when you go in, as you can see on the left-hand side of the slide, when you're in a disinflationary, when disinflation is certain, in many cases, there you go years without any occurrences, right? So, and that's money those are years where the NASDAQ is just kicking the Dow's butt, right? And so I think it's it's fairly ominous that on Friday last week, we had one of these signals, right? We had a day where the NASDAQ outperformed the Dow by close to 2.5%. And I think that should make people, at least pay attention.
And what might that suggest based on the thesis, Larry?
Think about, so from 1968 to 81, we were in that multipolar world with higher inflation. So 68 to 81. When that decade finished, the Dow, the industrials, the metals, materials, and oil and gas were 49% of the S&P 500's composition. 49%. Okay. So in a multipolar world with sustained inflationary regime, the industrials, your metals and mining, your oil and gas, they start taking larger market share in the market. And as of the last 6 months, within the last 6 months, the industrials, the metals and mining, oil and gas, they got down to 13% of the S&P, 13. So from 49 at the top to 13. So our point is in the book, if you move back toward a multipolar world with higher sustained inflation and higher yields, you're going to have those groups, oil and gas, industrials, metals, they're going to go from 13% of the S&P 500's composition, not back to 49, but I think for sure somewhere near 30. And so that means you need a whole new portfolio.
Just on a mean reversion basis alone.
Hey, sorry to interrupt again. It's Raoul here from realvision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
Let me ask you this. One of the questions that I think people have when we talk about oil, when we talk about natural resources, fossil fuels in general, I think some of the skepticism about those names stems from this a belief that we're going to be making this clean energy transition to renewables, to zero emissions, non-carbon producing technology. What do you think about that? I know this is properly a question about physics rather than economics, but why is there such a misunderstanding about where we are right now in terms of what our actual consumption demand is versus the ability of renewables to deliver the energy that the world needs?
Yes, and it's all about feelings and signaling, virtue signaling, and they mean well. I mean, there's nothing wrong with having a goal of carbon neutral 2035, 2050. It's a wonderful goal, right? But if you just look at the supply of the materials on planet Earth, just look at copper, look at cobalt, look at all the ingredients that go into producing a windmill, right? All the ingredients that go into solar. Our world, because companies and governments have suppressed, like right now in Panama, for example, one of the most profitable, one of the most highly producing copper assets in the world has been shut down by politics. And you think of ESG. Let me give you a very quick stat. Say from 2010 to 2014, we were in what's called a capital investment boom for oil and gas, metals, nuclear power. Everything was going crazy in terms of oil and gas. Nuclear industry ran into a problem in 2011 with Fukushima. But for the most part, we went up and capital investments in oil and gas and metals and mining exploded from 2010 to 2014. If we stayed on that current path from 2014 to today, right now we're in a $3 trillion hole based on that capital investment boom. So we're $3 trillion behind. But guess what, Ash? The global population from 2014 to 2024 is up almost 1 billion human beings. It's like 950 million. So we're suppressing the supply of energy through ESG, through political ambitions. But meanwhile, like I said, we've taken all these jobs out of the Rust Belt. We've enhanced the quality and the standard of living around the world. And now we're having a very sharp upward demand. So we're suppressing supply and we're juicing demand. And that gets you an energy crisis probably in 2025, 26.
Yeah, when physics and feelings collide, physics always wins.
Yeah, that's it. Wow, I'm gonna use that one. That I should have put in the book.
Okay, Larry, this next chart should scare you. This is a chart of interest costs servicing the U.S. debt and what's happened in the last few months. Let's pull that chart up if we could, Gab.
Okay, so once again, Team Biden has gone all in, and Yellen has it's you could say wisely, strategically. She's been issuing tons and tons and tons of the last 2 years of T-bills instead of bonds, right? So if you think back the last 50, 60 years, the percentage of T-bills, which are like 6 month, 3 month, 1 year bills, being issued by Treasury is, like almost two standard deviations greater than, most times. In other words, we're issuing so many T-bills, and there's a reason for that. Because if she had issued lots of longer dated bonds and interest rates are going up, there would be a ton more stress and volatility in the market, because a longer dated bond, a 10-year bond, a 30-year bond, moves violently to interest rates, right? So by issuing lots of T-bills, if you issue $1 trillion of T-bills and interest rates go up, say 50 basis points or 1%, those T-bills, because they're so short dated, they're not going to move in price. It's almost impossible to move a 3-month or 6-month T-bill in price unless the country's defaulting. But so what Yellen's done is she's jacked up the front end issuance. Now the problem with that is now interest rates have gone higher. Powell's going higher for longer, higher for longer. There's so much baloney in that statement, because if you really go higher for longer, your interest expense, if you look there on the left-hand side, you're going to reset substantially. You're going to reset dramatically in terms of your interest costs, and that's starting to happen now. And so, that's the setup. That's why higher for longer probably doesn't work. They probably get forced into some type of QE. But your average weighted coupon would go from like 2.5% to 4.5% if you go higher for longer. And so your annual interest on the debt would go from right now higher for longer this year gets you 1.4 trillion of interest. And if you go higher for longer for farther than that, as you can see here, this is the blood curdling gamble that Treasury's making. This is
the next chart, Gab. We're showing the debt maturity profile.
Yeah. So the reason why 15 trillion comes due in the next 3 years is because Treasury, like I said, has been front end loading all that issuance, 8.5 trillion in 1 year, and then 15 trillion over 3. And so the Treasury basically is just like, let's run out the clock. Let's prevent a recession. We had a banking crisis and COVID. Let's get out. Let's boom the economy through quasi-MMT, modern monetary theory, whatever you want to call it. And let's keep Trump out of office, and we'll deal with the repercussions later. But this is what I'm getting into. You got 15.5 trillion next 3 years. And if Powell really goes higher for longer, right? So this is why I want Bill Leisman, who's my friend at CNBC. I say, Bill, why don't you ask Powell this question next press conference? Chair Powell, if you go higher for longer, your average weighted coupon on all that debt on $15 trillion is going to go from 2.3 to 5.3%. How can you go higher for longer? Your interest costs are going to go up to $2 trillion a year. So higher for longer is complete BS. And I think that's gold, and some of these hard assets know that. Bitcoin knows that. And I think there's a lot going on behind the scenes.
Yes, since you bring up Bitcoin, I want to mention this because you actually talk about your view of Bitcoin and cryptocurrency in the book. Obviously, a rational person would have a lot of skepticism after what happened with Sam Bankman-Fried. You can see my book behind me on the wall there that I co-wrote with Artur Asinski and Elizabeth Bachman about Sam Bankman-Fried and the collapse of FTX. Talk a little bit. I think probably we know, and certainly viewers of this program know about the excesses we've seen in the crypto space, some examples of fraud, which you point out in the book. But also, you talk about the hard monetary cap on Bitcoin, 21 million Bitcoin that can be minted ever. You talk about that as something as potentially a hedge of inflation. How do you reconcile those 2 points of view? This idea that cryptocurrency is clearly the Wild West in many ways, and yet seems to have tremendous promise. It
does, and I'm a Bitcoin fan. What I don't like is people that, the pumpers. The amount of of pumping artists on Twitter and around the world. When strippers are actively pumping any kind of an investment product, I just take a pause, right? And so my point is in the book is the Bitcoin gold ratio, when it gets down to like 9 to say 16, that is when you want to sell your gold and buy your Bitcoin, right? But the Bitcoin gold ratio, when it gets up near, say, 28 to 35, historically, the last couple of years, last 8 years, you're better off, selling some Bitcoin and buying some gold. And it's just about like the strategic asset allocation around a rich asset, an asset that, any asset that has 4 drawdowns of 70 to 50% in like 5 or 6 years is extremely difficult. But imagine putting like $10 million in a Bitcoin or, a lot of money. Then all of a sudden that asset, that wealth of yours is going from like 10 million to 2 million, back to 10 million, back to 4 million. That's just, the biggest drawdown for gold in the last 15 years is 22%. Think about that. That is a store of value. That's something you can put real money into, right? And not have to worry about those kind of drawdowns. So it's not that I'm a Bitcoin enemy or foe. I just think you want to buy it at the right time and you want to beware of the pump artists. That's all.
Spoken like a true trader, Larry. Okay, on to the next chart. This is the 5-year auction.
Now, this is another one of the blood curdlers, right? So we were doing 5-year auctions like within the last decade, near 20 billion, 20 to 30 billion. And now we're up at 70 billion. So it just shows you that, that's a tremendous amount of, and so for investors watching us right now, one of the things that's been happening is people have been shorting the 5s and the 2s into these auctions. And then when the auction comes off, and it actually, comes off okay, a lot of times the media will go, the fans of different, different political spheres will be, oh my God, Ash, did you see that 5-year auction? Oh my God, it was so beautiful. It was very strong. Meanwhile, the 5-year treasury sold off like 20 basis points into the auction. You know what I mean? So what hedge funds are doing is they're selling short 5s into these auctions and 2s. And so there's that's what's putting a tremendous pressure on upward yields.
All right, the next chart, Fed balance sheet, what you were just talking about in terms of quantitative easing, where you see the rubber meet the road in terms of these large scale asset purchases.
Well, this is a good chart in the sense that it shows you, they made a decision when Silicon Valley Bank went down. That green explosion is like, that's easing, right, relative to QT, which is the red. So it's quantitative tightening versus quantitative easing. And so they have injected the most liquidity into the market in, I think, all time this year and since last March to now. And they are doing anything they can to, and which, like I said, every political party has done this going back 100 years, right? They will do anything they can to stay in power. But we just want people to know, if you look there on the far right, there's a little bit of stealth QT tapering going on. And there's some technical reasons for that, but there's an easing bias in the Treasury and White House. And like I said before, the Treasury and the Fed, everybody's kind of the asset prices globally are picking up on this easing bias, which you can see in the chart.
Larry, talk a little bit about the mechanism that the Fed uses to do this, to see those sharp green lines going skyward there, to be able to essentially buy assets quickly in emergency situations. What's the mechanism? How do they do it?
Oh, you think about the facility that the Fed used to bail out the banks. So the banks had these, imagine interest rates were so low for so long, right? They suppressed rates. And so the Fed came up with this facility that would hold to maturity assets off the bank books and
give them cash in return.
Give them cash. And part of that, that mechanism, it was that process. And so they're injecting, it's very technical. They're injecting money into the markets through bank reserves and all different kinds of ways. But
right.
You could see why they're doing it. But one of the things that in this inflation scare over the last 6 months has strengthened the dollar. And that dollar strength, once again, we're getting back toward that global wrecking ball, which I think the next couple of slides look at.
All right, this is what's happening in emerging markets. Let's bring that slide up.
Yeah, so the dollar has ripped because inflation has revived, and we were supposed to have 6 rate cuts in 2024. We're now back to almost zero, and so because of inflation surprising to the upside, the amount of the amount of cuts. We're supposed to have 6 cuts, and now we're back to almost zero. So the amount of cuts has evaporated. The dollar strengthened because the Fed's right now one of the most hawkish central banks in the world, but there's a price to pay for that. And so the dollar strength has put a lot. If you're a truck driver in Brazil, Ash, right? Imagine like your real's a lot weaker, and then you have to buy gasoline or oil in dollars, and so it creates tremendous political pressure and stress in the world. And the White House starts to hear about that behind the scenes, Treasury, and it really sets up for unsustainable global dollar wrecking ball that will probably force the Fed into a reversal pretty soon.
Yeah. All right, let's move on to the next chart.
And this gets back to how cheap. So the dollar's been, the Fed has been saying higher for longer for like 18 months, right? And so that hawkish shift over the last 18 months to strengthen the dollar because the Fed's, everybody, all the global investors, if you're a billionaire in Europe or in the Middle East, you and Yellen and Powell are offering you that 5% 2-year or that 5.5% 6-month T-bill. There's just too attractive. So that's sucking dollars into the U.S. That dollar strength is creating an incredible buying opportunity. Like right now, the EEM, EWZ, you want to be moving into emerging markets because they're just too cheap. And the ability to go, if Powell is really limited in his ability to go higher for longer, which we think he is because for a whole bunch of different systemic risk reasons, then your best trade over the next year and a half, it's going to be, you never want to marry emerging markets. You just want to rent them for a couple of years here and there. And that's the case right here. They're just too cheap.
Yeah, and the next chart is DXY, something that many of our viewers will be familiar with.
Yeah, so you can see there, this is the JP. So one of the so we run a Bloomberg chat with hedge funds, mutual funds, and pension funds. And one of the things that guys and gals in the chat talk about is like the local currency bonds are a great leading indicator on risk. And they kind of because they get beaten up the most when you've got the dollar strength because they're local currency in, say, Brazil or Pakistan or whatever around the world. There's in that ETF, that EMLC, there's like 200 different bonds, right? And so that dollar strength there, that ripping of the dollar every time is cheapened up emerging market local currency bonds. And this ETF pays 6.5%, and you have a decent chance at $10 or $5 of price appreciation as well. So once again, when you have these big dollar rips, you want to be looking at emerging market equities and emerging market fixed income.
All right, next chart is the term premium on U.S. Treasuries. This is an interesting one, Larry, because the world's been upside down for so long. Explain what we're looking at here.
Well, think about gold, right? And think about hard assets. Usually when you get a hot jobs number, as you had in the last couple of weeks, or usually if you get a hot inflation number that forces the Fed into more hawkishness, typically gold would puke lower the last 5 years. We've seen that over and over and over again. But gold has actually been going up. And so in a very mysterious way, gold is trading, the GLD is trading at one point, it was 22% above its 200-day moving average. And that's one of the highest points since 2011, right? So it tells you that how much money is coming into gold. And essentially what term premium is, and we talk about this in the book, we really do a good job of helping people understand. It's very important. For the last 20, 30 years in the world, if you were an investor in bonds, any kind of bonds, whether it be emerging market countries or the United States or Europe, the term premium is how much the global investor trusts a government on longer term bonds. And so for the last 20 years, from the US, we've had a very low term premium. And so investors globally trust the United States with passion. And treasuries were a very secure investment and in a disinflationary regime. But once you go into a sustained inflationary regime with a fiscal and monetary overdose and kind of an irresponsible behavior coming out of Washington in terms of just running reckless deficits, both parties. Like I said, in 2010, 11, 12, Republicans were forcing austerity onto the Democrats. Here, Democrats are in the White House and the Republicans are actually joining another party. That creates a term premium problem, and that drives money into hard assets and Bitcoin.
And that's what we see in the next chart.
And you can see how Bitcoin had the sniffer before gold. Gold is picked up, but Bitcoin really, you can't really see it there on the chart, but the performance of Bitcoin is the ultimate sniffer on where the Fed's going and on problems at the Fed. And gold and silver are secondary. But as you can see there, as we've gone into this higher term premium risk, where global investors are starting to look at the United States, maybe slightly more, the U.S. is slightly becoming more like an emerging market country in terms of the trust between the investor, the bondholder, and the government. And so that is what is moving the money into hard assets.
The next chart shows a gold breakout versus the S&P.
Exactly. So this is your, I mean, if someone told you that gold is outperforming the S&P since 2018, since the fourth quarter of 2018, would you believe them? But it is. So gold, as you can see there, and it's the rate of change, Ash, on the far right corner. When you see that kind of rate of change, that typically means there's something behind it. And so, as you can see, that rate of change in 2020 there with that sharp move, right? And so you want to be wary here that, gold is starting to outperform, and that's your money moving into hard assets relative to, remember, financial assets are just paper certificates, Ash, right? That's all they are. Bonds and stocks, growth stocks, are just paper certificates, right? They're not real assets. And they're promises in some ways from companies and governments. And so when you have a term premium expansion and when you have that kind of reckless behavior in Washington, you start to see this type of price action.
And you call that out very specifically in the next chart, hard assets versus financial assets.
Yes. And so there's the Dow, your Dow stocks are starting to underperform as well. So that line moving down is gold outperforming the Dow.
And the next chart, back to term premium, talk about that divergence that we see there. This is the copper to gold ratio.
See, this is this tells you that something's going on around term premium because you see that correlation between, so it's the copper gold ratio versus 10 year yields. And for over a decade, these two moved really in unison. But once, Biden and Trump moved into and the Fed moved into a 16 trillion fiscal and monetary response with no austerity behind it. Remember, the Lehman crisis was 4 trillion fiscal and monetary with a follow-on austerity. Now we're doing a fiscal and monetary of 16 trillion with no follow-on austerity. That is creating money. That's creating this chart. People trust bonds less, and they're moving into hard assets.
Larry, one of the interesting things about this is that as you mentioned, the divergence in terms of 4x, the response to the post-COVID crisis, or the COVID crisis moving into the post-COVID period. One of the things that's interesting as somebody who was around watching markets in the 2008, 2009 timeframe, people were screaming about it, right? There were people who were up in arms, who were genuinely upset about it, calls for the bond vigilantes to come out, which never happened. But why now is the response so muted when, as you point out, the actual policy action is 4x greater?
You know what? That is a great question. And we should have addressed that in the book. I think it was part of like the financial crisis. And there was a lot of people upset about the banks and the bailout. So,
by the way, hugely upset on both sides of the political spectrum, if you remember.
Yes, and people were really hoping Obama would come down hard on the banks. And there's pictures of Jamie Dimon sitting next to Obama smiling that I think there was that February in 2010. And so it was really a political outrage around, okay, we're bailing out, but the Obama team knew that they had to do that to really prevent a nasty recession or depression. So once again, typically you want to let the business cycle function. The longer you prevent the natural cleansing process from the business cycle of functioning, the more you create these excesses, right? And so I think that's part of it.
All right. Next chart is long duration equities. And this is CLOU. This is the cloud computing ETF.
Yeah, so this was the hottest sector from 2019 to 2021. Like I said, think of your DCF model, your discounted cash flow. These companies basically invest in software, and they invest their capital expenditures in the company, and they don't really pay high dividends. They don't produce a lot of cash, and but they grow. But those are future cash flows. Whereas the cash cows are refiners and oil and gas companies. If you look inside the COWZ ETF and look at the top 20 holdings, it's a group of big value names, your Exxons, your Chevrons. And so they produce lots of near-term cash. And like I said, they have lots of assets in the ground. And so one of the great leading indicators, like right now, the NASDAQ isn't necessarily getting killed by hard assets yet. But one of the classic leading indicators is kind of the tertiary growth names, like the software names and like the ARC names. And so I think this is a classic leading indicator for the NASDAQ. NASDAQ's going to have some big problems up against value and hard assets in the coming years. And this is kind of a good leading indicator of that.
Larry, if you wouldn't mind, I want to read something to our listeners and our viewers because I think this is so important. I'm skipping to the end here. This is the last paragraph in Larry's book. I'm going to set it up now because I think it'll give a little bit more context to everything that's about to follow. Because to me, Larry, this is just such a clear statement that you've made here. You've really you have the courage of your convictions to just come out and say what you think, and it's such an important point for people to hear and understand as we talk about all of these charts. And I quote, this is, again, the last paragraph of the last chapter of Larry's book, How to Listen When Markets Speak. Quote, places where billions are made will not always be that way. And sectors that once delivered tiny returns, if any at all, could one day be highly profitable. Precious metals, coal miners, uranium, copper, rare earths, oil and gas, once the great laggards of the stock market, will be among the most heavily populated sectors in the coming years, and big tech will fall into the shadows. The world is about to witness the most epic migration of capital in the history of financial markets. Will your family's wealth play a role in this and walk into that neglected meadow of value stocks, commodities, and hard assets? Or will it fade away with the last decade's portfolio? The choice is yours. Larry, reading that, I mean, the first thing is just how bold and decisive a call that you've made there. And the second point is this is really pragmatic advice in terms of portfolio allocation. Obviously, not financial advice. We're here to do this for educational purposes. But you come out and really state in a very clear and unequivocal way what all these charts mean and what the thesis means. Talk a little bit about that paragraph and why you decided to end the book there.
Well, there's some soul searching going on because I believe that. And in all of our research, in all of our, like I said, there's no I in team. We work with some of the best hedge funds and mutual funds and pension funds in the world. We host a daily conversation with them at the Bear Trap Support. And so those kind of mentors give me, a lot of confidence to make that call. But, there's some things that like artificial intelligence that really kind of like, okay, maybe this is different this time. But every time you think it's different this time, and through my whole life in the 90s, I mean, I lived through this. In the 90s, we thought that Global Crossing and we thought that companies like JDS Uniphase and Cisco, they were like the obvious trades for this new industrial revolution with the internet. And I look back and, so many of people I know got burnt by that thinking. And it was the second, and it was like you said just there, like we say in the book, it was the neglected sectors, those neglected parts, your Match.coms and other things behind the scenes, your Googles, your Facebooks, companies that developed over the next 5 or 10 years that really were able to harness the internet. And so we look now at NVIDIA and super microcomputer and artificial intelligence. And I just look at the commodity space and the power grid in the United States. It's 20 to 30 to 50 years old in some places. It's going to require a $2 trillion rebuild. The amount of copper it's going to be needed to rebuild the power grid in the United States is just jaw-dropping, and we just don't have the supply of these commodities to support a lot of our, not just green initiatives, but artificial intelligence initiatives. So if you believe the NVIDIA management team, and if you believe all the different analysts on CNBC that are upgrading NVIDIA, then the best trades in the world are going to be maybe in the natural gas space, in the copper space, companies that will behind the scenes support this incredible, industrial revolution.
So, Larry, to get one layer more specific from that, how do you then go about finding those potential winners in those sectors?
Well, in the next couple of pages, we go through them, and we have a team of, and you can share this with the viewers. What we do is we triangulate information. So you take a piece of information, you put it into the palm of your hand, and then you surround it with intelligence. And so because we run a conversation on a weekly, monthly basis with professional investors, we will vet these ideas out to the group, and we'll take our own analysts and do research on the companies. And these names in here are the names that we've come up with. And it was through 6 to 9 months, a year of vetting, of kind of looking at, okay, what do we want to, like, what's behind the data centers? What's behind the terawatt hours? What's going to support, like, even companies like Generac, right? Like Generac, if the power grid is stressed, then Generac is a company that backs up the power grid. So we got that idea from one of our institutional clients like 6 months ago, or even a year ago. And so, because we had that power grid problem in Texas, so it did a tragic one.
Right.
So we've been having more and more of these power grid problems, and people are starting to say, okay, if there's hurricanes, if there's power grid problem, there's all different ways to play it. There's companies that are going to back up an old grid, and then there's companies that are going to rebuild the old grid.
Yeah, Larry, I know we've got about 10 minutes left here, and I want us to, we can skip around here. If there's some points that you want to make that you think are really important, we can just jump through those charts.
Yeah, there's a couple of charts coming up that are really cool. There's the charts that are in the AI section. So one of them is Antero, which is, we've been playing this name for years. It's trading at, like, the company's bought back like 12% of the equity, right?
And so like chart number 30.
Yeah, Antero's producing almost 11% free cash flow yield. The company's buying back a ton of stock the last couple of years, essentially taking the company private. And these companies in the midstream are going to be, if natural gas gets, because of European demand with LNG, all these new LNG facilities globally, and then this artificial intelligence, you're going to eventually have a much higher price of natural gas. And then companies like Antero that are in the value space, they're trading, I think 3 times EBITDA, and they're trading 11% free cash flow yield. The risk reward is like, you look at, okay, you can be 40% down, but you could see 8, you could see this being a 10 bagger potentially. And so, that's one of them that we're looking at.
All right.
We have Southern Company versus, I think, the semiconductors is a good one.
That's chart 28, I think.
Yeah. So this is kind of funny because, obviously the SMH is the most obvious trade, right? Everybody knows, like, every Tom, Dick, and Harry, as they used to say in the 50s, knows the semiconductors are an AI play. Like, the problem with that is, like, these trades get too crowded. And one, think of Friday, right? Super microcomputer. This is fascinating, Ash. These guys, like, when you report earnings, if you're going to do an upside surprise, you have to do it by a certain date relative to the earnings date. And because they didn't come out with an upside, like another upside, basically pre-announcement, because they didn't do that, the stock dropped like 20, 30%, something crazy. Like, it was so that tells you that we're getting so idiotic land in terms of froth. There's so many, it's this junkies buying options, right? And which is fine, they can gamble, but they're turning this space into, like, a casino. Whereas companies like Dominion Energy, which are based in the South, and there's a lot of these problematic data centers that are massive energy hogs in Virginia and throughout the South that are, potentially big problems for communities, right? So if you're in one of these counties with one of these, large data center, uh, platforms, you're really what are they going to do? So what we think they're going to do is these energy companies are going to force the data centers to pay up a special rate, because it's not fair if you have one energy hog in one county, and there's going to be a lot of political pushback on that. So the profits from some of these companies that will support the data centers is pretty interesting. And then we have another chart where we look at some of the uranium names as well. But I think
That chart right there that we just flipped by, the 0 DTE chart, shows the
that's your explosion of the options.
if we could just flash that up real quick.
Yeah, you could see that's just AI turning the market into a casino. And that's, once again, that's the Fed offering a little bit of a combination, in December, and, the animal spirit's just taken off. That's people buying single day options like that. But in the nuclear space, next gen. So one of the things, Ash, I think is a great leading indicator in any commodity cycle, right? So nuclear is a big part of this whole AI story. And what's fascinating is the beginning of any commodity cycle, the mothership is the commodity, and that moves first. And think of like oil in 2020, the bottom, right? The first stage, people moved into to oil itself. Then, late 2020, people started moving to Exxon and Chevron. And then, lo and behold, a year later, people are moving into Hess, and people are moving into Marathon Petroleum. And so, in other words, the first stage is very, very cautious in terms of the beginning of a commodity cycle. And so with uranium over the last year, we've been recommending uranium to clients for almost 3 years. And we started to play Cameco. We've obviously played the Sprott ETF. But what we've noticed is NextGen and some of the smaller players are starting to outperform. And that's a sign that the cycle is maturing. You're moving into like maybe the second, third inning. And so that's, I think, a pretty good leading indicator. NXE, it's a speculative stock, and it has lots of regulatory risk, but your upside, downside, and also these small modular devices, like these small nuclear, these energy sources that might be. So you literally could have somebody like an Amazon, buy up property and buy up a nuclear energy source for their AI. So they
essentially for their own consumption.
For their own consumption. And so
top down and bottom up, Larry, you guys do a tremendous amount of work over there. Let's pull up one more chart before we have to wrap here, which is number 24, because I think this talks to the broader trend that you've been talking about here. This is Exxon versus ARC, man. Maybe in a single chart, this may say it all.
Kathy, God bless her, she's had she's had a great run, but the whole key to her thesis, she's been pitching disinflation and deflation for 3 years. And once again, long duration equities, companies that produce growth and reinvest the potential dividends, don't pay dividends, but they reinvest it in a growth trajectory. And then they try to pay you over 10 years. In an inflationary regime, those companies are worth a lot less. And so, but on the other side of the coin, ExxonMobil, that'll pay you a near-term dividend today and has lots of assets. If you move into that kind of sustained inflationary regime, I mean, you could see like BHP or Exxon, like in 5 years from now, and you look at the top 10 holdings inside the S&P or or inside the NASDAQ, about more so the S&P, you could see like a BHP or an Exxon being back in the top 5, right? Right now, the top 5 is all AI and, Meta, Facebook, obviously, Apple, Amazon, and Microsoft. But we think that the next stage of this is right now the first stage victims are the long duration equities, software, ARC, and there's a whole bunch of them. But the next stage will be when, and this will be when the book really gets proven out. And my fingers are crossed, but I think it's going to happen. Like within the next 5 years, 10 years, you will see your BHPs, your one or two of these large, your Valets being in the top 10 in the S&P, your Exxons, your Chevrons, and a whole new asset cycle domination.
Well, here it is. How to listen when markets speak. I would encourage you all to go out and buy it. Much more detail than I have the ability to blunder through in real time with my questions. And it's a great read. Really, really incredibly accessible book. These are not easy subjects that you're tackling here, Larry, but you write about this with both precision, clarity, and simplicity. I think if you've listened to this conversation, it's just a great way of being able to go through those points in a way that's just incredibly accessible to readers. And I really appreciate what you've done here. As we run out of time here, Larry, final thoughts, key takeaways that you'd like to leave our listeners and our viewers with.
Well, just, the burning desire to ask questions, right? And that's the one thing about my career is, I was a retail broker in the 90s and I had to work my way up all the way, to the institutional side of the business. Very intimidating. But over the years, I've just built up a great reservoir of mentors. And, Steve Jobs said this over 10 years ago, like when you ask smart people for a favor in terms of learning, they typically say yes. And you just keep asking. So I'm a great asker. And I think that's the key. There's no I in team. I owe the whole book to, a whole host of mentors that are in the book. And, I think that's the way to broaden out your investment base and knowledge.
Larry McDonald, you're such a great guest. We share that intense passion and curiosity for markets. Thank you so much for joining us.
Thanks, Ash.
Thanks for watching. Thanks for listening.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.